Well, greetings and welcome to my first video blog, or vlog as they call it. Hopefully the first of many to come. But I just wanted to say greetings. It's been quite a year, hasn't it? We've had record highs in the market in February, followed by a coronavirus pandemic, government shutdowns, and of course new fashion statements. You know, we're all used to these things now. And the fastest bear market decline in US history back in March, followed by the fastest recovery in US history, April through June. During that time, this whole pandemic season, it's important that you know that we're here for you. And we have been and will continue to be. Back in March, we increased our email communication from monthly to weekly. Hopefully that was an encouragement just to stay fully invested and stay the course. As of August 31st, all of our risk models were back on track, from aggressive growth to ultra conservative in varying degrees for each individual's needs, objectives, and risk tolerance. And we've hit a couple bumps in the road here in September, so may not be totally done with volatility, but the key is, while past performance is not a guarantee of future results, we made it out of the pit. It really highlighted our process, and I hope this will be an encouragement. As we know, market timing is impossible. I'm a firm believer that it's impossible because the market is so unpredictable from day to day. We just can't guess at what might happen. So rather, we stay fully invested and we utilize a technique known as rebalancing. It's a global best practice used by all of the major institutions, from Ivy League endowments to pension systems to foundations. And it works like this. Essentially, imagine your portfolio has two buckets. We've got a growth bucket, such as stocks, and a stability bucket, such as bonds. And we want to maintain a consistent ratio between those two buckets in each of our risk models. So for example, in our income with moderate growth strategy, we want to maintain a roughly 50-50 ratio between growth assets and stability assets. And so in that case, if stocks rise, such as last year, we had a very strong 2019, that pushes the ratio of stocks higher. So instead of a 50-50 ratio, that portfolio may have drifted to, say, a 60-40 ratio between stocks and bonds, in which case we would sell some stocks and buy some bonds to get back to 50-50. And that's actually precisely what we did back in January for all the accounts. And then conversely, if the markets fall like they did in March, that might push the ratio of stocks down to, say, 40-60, assuming the bonds remain stable. And so what we would be required to do as a discipline is sell some bonds and buy stock to get back to 50-50. And so now typically rebalancing will happen once or twice a year as the market gradually moves one direction or the other. But in 2020, we actually rebalanced 4 times. Twice in the month of March alone. And as a discipline, our system alerts us when the portfolio has drifted too far, and we respond. And so before you get worried, we pay all of the trading expenses internally as part of our SAM2 platform with LPL. So the expense of trading was on us, but we bought a meaningful amount of stock in March and at bargain prices in every single client account simultaneously, because we believe that was the right thing to do for our clients. And LPL has amazing trading technology. It's literally thousands of trades that we initiated with what a few decades ago would take an entire trading department a full week to accomplish. And we did it all in a matter of minutes with a few clicks. So all of our clients owned a little more stock during the recovery in April through June than they owned on the way down in March. And that's a contributing factor to where we are today. Now, here's the beauty of this technique called rebalancing. First, it removes emotion completely from the decision-making process. It's not based on headlines or market predictions. It's just math. It's looking at ratios. It also, the second thing is it encourages the right investor behavior, which is to buy low and to sell high. And here's the best part. Rebalancing is repeatable. So if we experience new market volatility, we continue to stay fully invested in our model strategies, and we'll rebalance again to take advantage of any potential future bargain shopping opportunities. So while the economic outlook outlook published by LPL Financial Research still makes a strong case for optimism, which you can access on my website blog. And while past performance is not a guarantee of future results, we've got an election coming up, we've got some market jitters here and there. But here's the point. We're ready to respond to whatever the market does next. We have a technique that works with rebalancing, and we're here to help you weather the storms. And also, while we are experiencing these market recoveries, we want to keep our buckets out while it's raining, right? We want to catch that performance if we can. And all of this investing is from a perspective of our specialty in faith-based investing. So just know that we're working hard behind the scenes, and on behalf of our entire team, we just want to thank you for the privilege it is to serve your family, and please feel free to contact us with any questions.